Wes-tone here. In this video, we're going to look at Bitcoin, altcoin, and liquidity cycles. First, we're going to start with Bitcoin. We already established that there is a roughly 4-year cycle in Bitcoin. We estimate that by just simply measuring peak to peak. Here we got exactly 4 years. Here we've got a little bit shy of 4 years. 208 weeks would be 4 years. Here we have roughly 4 years, maybe slightly longer than 4 years. So we're just going to call it a 4-year cycle. So then what we do is we take a signal clarifying simple moving average, which is 1/4 of the cycle length, 52 weeks, and then offset by negative 1/8 of the cycle length, so 26 weeks. So that's what our signal that gives us the smoothest looking cycle curve that we can get. Okay, and you can start to see the smooth cyclicality now. The other thing about Bitcoin is it follows a power law. So I'll add the power law curve in there, and you can see here we have the most. These are based on fundamental physics. So, as opposed to like head and shoulders patterns, wedges, these sorts of things are very arbitrary and unreliable. Power laws and cycles are built into the fabric of physics. So very fascinating phenomenon here. So the next thing I like to do is just sort of smooth out this signal clarifying moving average with what I call the idealized cycle curve, where I basically just draw this as tightly as I can over the cycle, over the signal clarifier, and that gives us some level of predictability because now I can measure from this peak to this peak and call it about 200. I got it drawn a little bit rough there, but it's about that 4 years. So the Bitcoin 4-year cycle seems to be built into the fabric of Bitcoin. Gold, being another form of sound money, also, interestingly enough, follows a very, very clear 40-year cycle. And these cycles appear to be present most in sound money and possibly in debt. So interesting, assets and debt being the inverse of one another. Other assets don't tend to show quite as clear of cyclicality as these. So now let's overlay one indicator that I have found for measuring liquidity, and I don't really conceptually understand what this is measuring or why or what it means, but when I overlay it across other assets, it's a reliable, it kind of acts like an oscillator for liquidity peaks and lows so that I can differentiate between a cycle move, so I can differentiate between a divergence from the cycle and a contraction in liquidity, because this chart is Bitcoin as measured in US dollars, and we have to know what's going on with US dollars. That's kind of what this tells me is, do we have sort of an abundance or a scarcity of US dollars, which may affect and warp the Bitcoin cycle. So if I just pull that up all on its own, we get kind of an oscillator here. So you can see that when we get down here, this is the 2000 crash, the stock market crash. This was the 2008 financial crisis, both of those being very significant financial events, and you can see how low they are in the channel. The only other time we reached that since then was the COVID crash of 2020. We visited there in 2015, almost in 2022, and most recently with the tariff crash in March of 2025. it looks as though we're bouncing from that. We're just a few weeks out from that. It's always possible we could crash lower into a deeper crisis. So we don't really know what's going to happen here. But typically it doesn't. Typically once it gets down into this range, it doesn't really bounce and go lower. It tends to bounce straight up and out in a fairly clear fashion, but hey, we never know. One thing we can do with this liquidity oscillator is just start measuring peak to peak, peak to peak, peak to peak, peak to peak. Okay, same with trough to trough, trough to trough, trough to trough. If I take all those and average them out, we get and they're fairly consistent, so we get a range of about 120 weeks all the way up to about 200 weeks with an average of about 165, 170 weeks. That gives me a little bit of confidence as a little bit of prediction value, so to speak. So if I take the center of this peak and measure it 165, 170-ish, that's what this line and this red shaded spot is. So we can expect historically to have some sort of peak in liquidity. I don't have a clue how high it's going to go. That doesn't necessarily seem to matter a whole lot. To some degree, I guess it does. But the point is we'll have a relative abundance of liquidity peaking somewhere in this area. We're going to say March of 2027 is an estimated liquidity peak. Going back to Bitcoin here. So we've got Bitcoin idealized cycle in black. Now I'll just put this on here so you can see where we're at. One thing you notice when you overlay Bitcoin with the liquidity cycle is that the liquidity and Bitcoin cycles have largely been synchronized until now. So if you follow my dotted line here where my cursor is, we've got a Bitcoin peak here, very, very close to a liquidity peak. If you line these up, we've got a Bitcoin trough following the cycle trough and not the nominal trough. The cycle trough largely correlates with the liquidity cycle trough. The Bitcoin cycle peak largely correlates with the liquidity cycle peak. Okay, we had this one. This Bitcoin cycle peak was a little bit before the liquidity cycle peak, but more or less, not too far apart. We had a liquidity cycle peak with a Bitcoin cycle peak, again, synchronized. Here again, we had a contraction in liquidity right about the time Bitcoin collapsed here, followed by a bit of a bounce in liquidity and a bounce in Bitcoin, followed by the COVID crash, a major liquidity crunch. This liquidity peak here, however, has not correlated with a Bitcoin peak. Bitcoin seems to have gone up pretty significantly from past the center of this peak. And so we had this tariff liquidity crunch here, which did pull Bitcoin. It caused Bitcoin to diverge from its cycle quite a ways. And I'm going to add our signal clarifier back onto here just so you can kind of see what's going on. When liquidity bounced here, you can see the signal clarifier diverged away from the idealized cycle. And here, this contraction pulled Bitcoin, kind of rebalanced it to get it right back on track with its idealized cycle. And when liquidity bounced here, Bitcoin outperformed its quote idealized cycle here. So my point is that it appears that the liquidity cycle pushes and pulls and warps the Bitcoin cycle, but it does not dictate the Bitcoin cycle. So the Bitcoin 4-year cycle seems to be fundamental, and the liquidity cycle just kind of warps it in terms of US dollars, because if you took Bitcoin and measured it in gold, you wouldn't see these same divergences. So it's a function of US dollars or fiat. So what's interesting here is this contraction in liquidity happened near this Bitcoin peak. So presumably Bitcoin will follow its cycle, and presumably liquidity will bounce from here. I've drawn in the average liquidity here in pink or orange or whatever. So what's interesting here is that if liquidity warps the Bitcoin cycle, okay, it warped it to the downside here, but now if liquidity is expanding, that could pull Bitcoin to have actually a later than expected peak. Everybody's expecting, the cycle is expecting to have about a Q4 of 2025 peak, right about here-ish. But given that liquidity is going to keep expanding, we could push that Bitcoin peak out into Q1, Q2 of 2026. And then interestingly enough, for the first time, the Bitcoin cycle trough, the Bitcoin cycle will be out of phase, 180 degrees out of phase from the liquidity cycle. So that could create the illusion that the Bitcoin cycle has broken. What that could end up looking like is like a very, very high peak, late peak in early 2026, because you've got a convergence of the Bitcoin cycle and the liquidity cycle both being on the upswing. However, Bitcoin should be crashing during 2026, but liquidity should theoretically be expanding, which could put some upward pressure on the Bitcoin trough. Typically, we pretty reliably come back down to this lower power law regression band. That may not happen in this case, being that the two cycles are out of sync or out of phase. Bitcoin could just end up sort of almost trading kind of choppy and sideways while these two are out of phase, before really taking off again once liquidity expands at the same time that Bitcoin expands. Now, of course, this liquidity cycle is not perfect. This is just an average. So we'll have to keep an eye on this and look for the potential timing of this. But taking the averages of these cycles could create some interesting unexpected dynamics, just like the one we've seen here, because this was a very unexpected move for me and everybody else who was expecting alt season, which we'll get to next. Liquidity affects alt season more than it does Bitcoin, but this was a pretty dramatic divergence from the expected cycle, the idealized cycle. But it's probably only going to get more unpredictable as the liquidity and Bitcoin cycles desynchronize. Throughout it all, though, throughout this whole crash, Bitcoin has very reasonably held up despite having a large liquidity crunch. The same cannot be said for altcoins. Let's look at Kaspa, because this is another one I've talked about. Myself and many others believe that Kaspa is finally very potentially the silver to Bitcoin's gold, because it also follows a power law. The only two cryptocurrencies that follow a very significant R squared of 0.90 or above until recently, until about December 2nd is really when the power law really started to fail, because we had this expected bounce here and we were expecting it to hold up here, and it did not. And that was a very significant break in the power law of Kaspa. Interestingly, the liquidity cycle contracted right about the same time that Kaspa broke its power law. So many people were questioning the integrity of Kaspa's power law, including myself, not realizing that it's really a denominator effect because you're measuring it in dollars. We had a contraction of dollars, and that made it appear as though the power law broke. And if we take other, I'm going to maintain that I believe that the Kaspa power law is still intact, although maybe not in as measured in dollars, because dollars are volatile, unsound money. So dollars are a very poor measuring stick, which creates these sorts of issues here. If we look at Bitcoin dominance and we take the same signal clarifier, an idealized signal, I figured this move here was the big divergence, and then this move here was the expected kind of reversion to the cycle because the price was diverging from the cycle trend. That creates very big moves. But then we had, starting coincidentally on December 2nd approximately, this massive divergence in the wrong direction, completely obliterating the expected cycle. What this suggests, Bitcoin dominance is a function of Bitcoin and all the other cryptos. So altcoins are risky assets. They're most affected by liquidity. So when you have a contraction in liquidity, you have a magnified contraction in altcoins, which is kind of what this Bitcoin dominance is showing us, right? Because starting December 2nd about, that was when liquidity got crushed. Look at the pink line here's diverging. The Bitcoin dominance is diverging. That's telling me again that this move here, this unexpected move, this was a liquidity-driven move and not necessarily a cycle breaking move. It's just that we measure in dollars and dollars suck at measuring, so it creates these kinds of problems. But if liquidity is now expanding and the Bitcoin dominance curve should be dropping, this is setting up for a very potentially significant move in altcoins. And so notice here we have a Bitcoin peak right around Q1 of 2026. We have a liquidity expansion into that same period, and we have a Bitcoin dominance, which should be falling during the same period. These are a convergence of really three different cycles, the Bitcoin, altcoin, and liquidity cycle, which could make for, as I said, a very dramatic move in risk assets and altcoins. And we've just started to see a pretty significant bounce. Now, Bitcoin dominance specifically is also a function of Ethereum and is very much correlated to the ETH-Bitcoin ratio, which has just bottomed at a key level and hopefully, presumably, will bounce off of this level, which would be a significant factor in the reversal of Bitcoin dominance. If we eliminate Ethereum, we get this measure of alt season, which appears to be much more rounded and well on its way to following its cycle. However, again, starting December 2nd, we had this unexpected divergence, which I think can be explained by the contraction in liquidity. Yes, again, liquidity could contract further, and this thing could go even more out of whack, and that remains to be seen. Another altcoin metric that I like is the others Bitcoin market cap ratio. This one kind of showing a similar thing where we had this bounce, this outperformance of altcoins relative to Bitcoin. At the same time, we had this bounce in liquidity. And given that we had this bounce, I was kind of expecting an underperformance in this area to compensate for the equal and opposite reaction where we had this positive divergence. Now I would expect a negative divergence, which did play out and it did bounce, and I figured all looked well. And then again, starting December 2nd, when liquidity crashed, that's when this also really appeared to bust the cycle. We'll be looking for a bounce in liquidity and a bounce in altcoins. But if we do get a bounce in liquidity, if we do get a surge of liquidity, that could really dramatically fuel this reversion back to the cycle, the idealized cycle. Here we have the others market, which is the total market cap minus the top 10. See, we had a perfect sort of conservation of energy move here where we outperformed and then we came back down, underperformed, and then rebalanced right back on our way to holding that cycle. And then right about December 2nd, you look at the bottom there, the date, we had this contraction, same time as liquidity. So that really threw a kink in the cycle. But again, I believe the cycles are fundamental, and it's just about reading the interaction between the two energies, cycles, and presumably from here we'll bounce, and if we do get a significant liquidity expansion, at the same time we've diverged dramatically from our idealized cycle, this could set up for a very dramatic move. However, it'll have happened much later than people were expecting, months later. But at this point, I have to believe that the fundamental cycle is still intact, just being warped by liquidity. As always, none of this is financial advice, just some crazy lunatic trying to read the charts.